Welcome, everyone. Welcome, everyone, to Emory Atlanta 60 Plus Networking Group. So glad that you could be with us here today for our, is it fourth or fifth event? I'm going to go over the Q&A before I introduce our fabulous guest speaker for today. Similar to how we've done other events, you can submit your questions in the chat, which is at the bottom of the screen. In the center, if you don't see it, roll your mouse down your screen and it should pop up. And you just click the chat and you can send it to me, or you can send it to everyone. It's probably easier to send it to everyone. And then when Jeff is done speaking, we will open the floor for questions. And I will call on you in order of the questions submitted. So we may have an opportunity to be a little more interactive today, which is exciting. Okay. So you may have noticed, for those who've been with us the whole time, that this is our third Goizueta professor, and that is not just because we had nowhere else to go. When you go to Goizueta Business School, there are 3 professors that you know you have to take or you've wasted your money. And you've already seen 2 of them, Dr. Sheth and Rick Gilkey. And today we are incredibly honored to have the 3rd member of that trifecta, and certainly the most famous of the 3, Dr. Jeff Rosenzweig, with us. You should have gotten an email today as a reminder of the event from Jenny. Fantastic email with Jeff's bio, and it's extremely impressive. I'm not going to read any of it. You can search for Jenny's name and read it while I'm talking. That won't bother me. It is absolutely worth a read. It's just 1 page, so it barely even scratches the surface of his talents, but you'll quickly see that he is extremely experienced and extremely knowledgeable, and every news media outlet on the planet asks for his opinion. And we're so lucky to have him here at Emory and have him with us today for our 60 plus group, sharing his fountain of wealth. But not only is he a media expert, and not only is he a fountain of wealth, he is one of the kindest, most positive people I have ever met. When you're a student in his class and you say something wrong, he'll spin it to make you, not that I ever said anything wrong in class, he'll spin it to make it sound like you were on the right track. And I've seen him do it at Emory events. I've seen him do it on CNN, MSNBC. He's just incredible, and he means it. It's from the heart. The Wall Street Journal named him one of the top 12 all-time favorite professors, and that was true at Goizueta long before that. So I will stop going on and on, because I think you know how I feel about him, and Jeff knows how I feel about him, and we'll get to what we came here for. And I will turn it over to you, Jeff.
Well, thank you, Andrea. And you know, Emory made a very intelligent decision to finish everything before Thanksgiving, so that students don't go home for Thanksgiving, come back, go back again at the end of the semester, and bring illness both ways. So it's an extremely busy week at the end of the semester. But when Samantha Renfro asked me to do this, I said I would do anything for Sam. For so many years, she didn't just do one role, she took whatever role on our senior staff was needed, where we need a real star. Andrew was also a star student. So it's a pleasure for me to do this, particularly given the distinguished audience. Our timing couldn't be better. Maybe that was Samantha's design, because we have a new president-elect who will come in with new policies. We have an economy that is extremely volatile. It is clearly growing. Stock market is hit a new high the other day. But we also are at a point of a lot of volatility. Good news about vaccines, but will they be distributed? And that, of course, will impact the path of the economy, whether or not we have to lock down again. So I have a number of brand new slides that I think will be highly relevant. They're original, but also I really look forward to active Q&A. So I'm going to turn right to the very first slide. And for those who are on live or who will see this on YouTube, I want you to understand that we're going to take an outlook And we're going to look not just at the outlook for the US and the global economy, but we're going to be thinking about economic policy, and feel free to ask questions about policy. Some of that is still to be determined. For instance, as we see who will end up with majority control of the Senate, that will be determined right here in the state of Georgia. But we'll have a wide range. And you see, we start out with a map of the world. So you can ask me about the global economy as well as US. Okay, our first slide, as we move into it, you might think, where's the economics or the finance? Since I'm a professor of global economics and finance. But I think it's important to start with what is going on with the pandemic we're in. And these graphs show not cumulative cases. Of course, they go up. It's total cases since the beginning, but it's new cases being reported every day. Now, things jump around day by day. So the dark red lines are the average of the last 7 days. You probably see this in the New York Times every day, or if not, you go to JHU, MAP for Johns Hopkins University does a great job. But the sad thing is we are hitting all-time highs in new cases of COVID every day. You can see it's our third wave. We had that second wave in July when Arizona and Florida and Texas had so many cases. The difference is now is it's countrywide, including Georgia. We're not as bad as some of the places in the Dakotas and Illinois, kind of in the upper Midwest. But in Georgia, we've also doubled our new cases in just the last month, doubled. But as we see, we're hitting records, and we just hit yesterday 160,000 new cases. Looking down, notice that the world had 480,000 new cases yesterday. That's quite interesting, because if you think about it, 160 is exactly 1/3 of 480,000. We are accounting for, what are we, about 4% of world population, but we're accounting for 1/3 of the new cases. So we certainly have a problem on our hands. Again, we have a growing economy. We've had some good news on vaccines, and that's why the stock market is at all-time highs. But as we move through, when we think about an economic outlook, we really have to worry about a scenario. The main scenario is that we'll keep growing, but there's a secondary scenario we have to think about as citizens, as investors, which is the economy might not do the check mark that everyone is thinking about. Came down quickly. No one was looking for a V, coming way back all the way up quickly. The stock market did. We were looking for a check mark or a Nike swoosh, down quickly and then up in a sustained but not a steep pattern. That's what we've seen, and that's probably the scenario, the main one. But we do have to worry about a secondary scenario, a possible W, if the cases keep going up at this rate, and we would have to have something of a partial lockdown. Notice that due to better treatments, et cetera, the mortality rate is lower. The amount of people that get a case will ultimately pass away, but our deaths are up 38% over the last 14 days. If you look at the top graph there, on a worldwide basis, deaths are still quite high and up 28%. So again, I'm not here. We have great public health experts at Emory. I'm here to talk about this makes us wonder about any economic forecast going forward. Will we have to do a partial lockdown? Will that cause a double dip recession, another turn down in the economy? So we'll move right into the next graph and give you the mainline forecast, the basic scenario, which is that every country, these are the major economies, every major economy other than China is going to suffer economic decline, a decline in its real, meaning inflation-adjusted GDP, total production in 2020 compared to 2019. That's the yellow bars. China, which is kind of ironic because the pandemic started there, but they locked down so severely and so quickly that they were able to open up their economy and get growing again very quickly. they're the only major economy that is actually exhibiting economic growth this year as a whole. And other nations have varying levels of decline. The UK, as many of you know, has had to lock down again, basically lock down, because they have a rapidly increasing wave now and a lot of deaths as well. So it's a tough situation in the UK. Also, India, for a while, surpassed the US as the kind of the worst place for the expansion of this pandemic. It's getting under control a little bit now, which is very good news. So you see that India and Mexico, as long as the UK, having really bad economies this year. The US, nothing like that. Germany has done much better than the UK or even France, for instance. So Germany's economy, the US, Japan, Canada will decline, but not at the rate of the three that are declining more steeply. I'd like to draw your attention to the fact that in this mainline, this basic scenario, if we don't get overwhelmed by new cases, the economy will grow in 2021. That's green. Our economy, and actually every major economy, is forecast to grow, but that growth won't quite make up for the losses we suffered, particularly in the first half of this year. So at the end of 2021, if things go well, we'll be almost back to where we were, that peak of the economy before the pandemic hit, but it will probably be into 2022 that we're all the way back. And of course, our economy normally grows about 2.5% a year. So even if we get back to the level of where we were in this winter, we've lost 2 years of growth or so by then. So there's real suffering, and I'll be showing that with the job market soon. You know, because of the aging of all the what are called the advanced economies, the mature economies, the rich economies, it's not just the US that has a baby boom that's retiring. So we'll have a much greater percentage of our population in retirement age. It's even more so in Europe. You say we'll still have a growing labor force because of the millennial generation, an echo boom. The baby boomers average 2 kids. We also have some immigrant workers come in, including some very, very skilled and intelligent people coming to Emory, staying in this country, contributing in our workforce. But still, our workforce will grow not nearly as the rate of our retired population because of the aging of the baby boomers. But in Japan, in Germany, we won't even see the growth of labor force. Their labor forces will decline as their large post-World War II baby boom generations retire, because they never had a millennial generation. They didn't have this echo, 2 parents having 2 kids. They had more like 2 parents averaging, on average, 1.5 kids or less. So they're not even replicating themselves. Their labor forces will decline. Also, a country like Japan has not historically been as open as we are to talented immigrants who come to our universities and stay and contribute to our nation. One thing I'd like to do is talk about other countries that will do well. You see here, UK, Germany, Japan, even Canada and ourselves, none of us will grow fast. By the time we get out to 2023, the red bars, we're assuming that the pandemic is behind us. This gives us a better feel for what is the more long-term economic growth trend we can expect various countries to be on. And again, all the advanced economies, which are Canada all the way down, other than Brazil, we're going to be growing less than 3% on average. In the case of Japan, where their labor force will shrink, more like 1%. Germany, 1.5%, which will be similar for France or Italy, Spain. They're all very much aging societies. This doesn't mean that, for instance, Japan is poor or Germany. They're going to remain some of the richest nations on earth. What really matters is your per capita production, your standard of living comes off of your productivity, your per capita production. And of course, these are nations that are very high in that regard. But there are nations that have the opportunity to do some catch up, to implement some technologies, to continue to train their workers and also have greater percentages of their population go to university. And China has been moving along that path, and more recently, India. India will have a better economic growth path moving further forward than China because China had the one child policy, which means their labor force will shrink. It's just beginning to shrink as their high birth rate in the 1950s and the 1960s, in some sense their own baby boom, as they're starting to retire, they're not supplemented by an echo generation by millennials because they had the one child policy. Whereas in India and Indonesia, there were about 3 kids per family until recently. Now it's a little less. And that means that they have labor force growth, but they're not being overwhelmed by an increasing ratio of workers to retirees. So what we see is a very bright future for Indonesia and India, particularly, as I said, as they're increasing their education rates. In this particular graph, because I ended 2023, and India is having some pains coming off of the pandemic, et cetera, it's actually Indonesia that is ranked first in economic graph. I rank these in descending order based on how fast do we see countries growing in 2023. Indonesia will do very well in the future, but we do anticipate that India may rebound even closer to 7% annual growth and will be the fastest growing big economy on earth, as it has been in recent years. Until about 8 years ago, China was the fastest growing economy for 3 decades, ever since after Mao passed away. It took some time to consolidate power, but Deng Xiaoping consolidated power and opened China's economy up to more of a global capitalist model, attracted some foreign investment, and the economy grew so fast that I call it a hinge of history. It went from a very poor nation to a nation that, on some measures, is now the world's biggest economy. Not per person, of course. China has that huge population, but still an incredible growth record. But it will ultimately decelerate because the population is aging, and its economy is now much bigger than India's because, again, China started growing at rapid rates decades before India. But the future really is perhaps North America, China, India, and we'll see what happens with the European Union, with Brexit. Will the rest of the European Union hang together? I have good hopes for Latin America, although we can see Mexico and Brazil right now are underperforming where they will be. I don't mean right now just during the pandemic, but if you look at the blue and the red, they're still not forecast to grow at the kind of rates they should be. They have good demographics. They're not aging. They just need to have better policy, and let's hope they have governments that have more stable positions in general, and particularly better economic policies. We'll move to the next graph. And again, you'll be accumulating questions or putting them in the chat, and Andrea is monitoring them. I want to talk about something that is probably on your minds, which is government debts and government deficits. And some of you have probably been amazed because in your working careers, and I know some of you are still working, this group is age 60 and above, but you knew that the US had some deficits, that we were spending more than we were taking in as a federal government. Now, how does a government have a deficit? Spend more than it takes in tax revenue? Well, it has to borrow to do that extra spending above its tax revenues. Our government borrows by selling treasury securities. And some of you hold those in your retirement accounts. They're considered the safest of bonds because they're backed by the US government, which not only we can tax to pay them off, but we can also print money. So the US, for most of its history, has run government deficits. And that means we have to borrow, which means issuing treasury debt. The debt the Treasury has a debt. And you as individuals can buy them for your retirement accounts. Life insurance companies can buy them to pay off when people pass away. Pension funds can buy them. What's interesting is we never had very large deficits, which meant that we were borrowing a lot and there was a rapid increase of debt until the 80s. And this graph, which goes all the way back to 1986, shows that the biggest deficit started happening late early 90s, and the bars are in dollar terms. We hit almost 300 billion. It's one reason that the first George Bush didn't get reelected and Clinton did. He was blamed for a large deficit. As a share of GDP, because our economy was smaller then, you can see that the deficit at the maximum hit about 4.5% of GDP. Then we had some surpluses for a while during the dot-com boom when a lot of tax was coming in. But then we had the housing bubble burst and the crash of housing, followed by the financial crisis that you're all familiar with. Some of you in your 401ks, they became 201ks because the stock market literally lost 57% during that crash in 2008 and 2009. Unemployment ballooned. So people weren't paying income tax or Social Security tax. We weren't paying capital gains taxes because we were making capital losses on our investment portfolios. And the deficit ballooned. And as you can see from the bar, it got, and using the right-hand scale, it got as big as $1.4 trillion, beyond anything we ever could imagine. Well, we could imagine at the time. And it went to 10% of GDP, as you can see on the left-hand scale. Well, along came the Trump tax cuts, and they may have helped stimulate the economy. We had a bit of a Trump bump in the stock market and economic growth, but we also had increasing government deficits before the pandemic. You can see the second to last one of the solid bars. The solid bars are actual data. The dotted bars are the current forecasts. Well, we went up to $1 trillion deficit in 2019, even though the economy was growing well with President Trump, et cetera, because the tax cuts, they may have stimulated the economy, but they led to a larger deficit. But we hadn't seen anything until the pandemic came. Now, I'm not here to criticize anybody. In fact, I think we did the right thing. A Congress which was controlled by some Democrats and then some Republicans and a Republican president and the Federal Reserve acting aggressively. We were not in an economic recession in April. We were in a depression, the only economic depression since the Great Depression of the 1930s. Fortunately, this only lasted 2 months. So maybe when they look back at it in history, they won't call it the second depression. But let me give you an idea why some of us call it a depression, not a recession. In a recession, you could lose a few million jobs, maybe even 8 million over a couple of years. We lost 22 million jobs in the US in March and April. And that doesn't even include the millions of people who were put on part-time by their companies because their companies didn't need them very much. They just wanted to keep them on the payroll, for when things got better, because these people had experience, they would be useful maybe after a vaccine. We lost 1 out of every 7 jobs, and other people, like I say, were put on part-time involuntarily. They wanted full-time work. So we had never seen anything like that in such rapidity. But since then, the economy has come back, and we'll talk about that later. But the reason we did start coming back, other than the fact we ended the lockdowns, is the CARES Act. The government stepped up adroitly, Democrats and Republicans, and said, we've got to send $1,200 checks out to people so they can pay some bills. We've got to radically increase what we're doing with unemployment insurance and make it available to people who didn't get unemployment insurance before, people like Uber drivers. And by doing this, they put money in people's pockets so they could still pay their rent or feed their kids. So I believe, we could discuss this in the Q&A, but I believe the government did the right thing, but it led to again, deficits, a government deficit like we never thought we would see, over $3,000 billion. These are billions on the right-hand side, so 1,000 billion is a trillion, over $3 trillion. And if you look to the left, when you look at that black dot on 2020, the last solid bar, over 15% of our GDP. Remember, it had never been over 10% except during World War II, when of course we spent a lot to win the war that would end all wars. All right, now you might wonder, how do I have 2020 data? The government's fiscal year ends September 30th. So luckily I just got that data. Forecasts are that with the economy growing, the deficit will get much smaller. Chances are we'll need a second round of stimulus, but not to the extent we did with the CARES Act, the multi-trillion-dollar. And as the economy has grown, we've got a lot of people working again. So thankfully, they're earning a paycheck, paying income tax, Social Security check, and they're moving on to a better life, as well as paying into the system. But still, we have deficits forecast as far as the eye can see. I don't think they're going to cut Social Security payments or Medicare payments. It's not fair. People have been paying in for decades. I don't think we'll cut those, at least for people, let's say, over age 50. If I was age 30, I would certainly be increasing my personal saving and investing, being afraid that there may be some cuts to something like Social Security 20, 30 years from now, because these deficits are so huge. We'll move to the next slide. I've got Andrea monitoring in case any great questions come in. She can interrupt me at any time. But I just talked about the consequence of running huge deficits. So we were all already running, or I shouldn't say running, I mean overspending, if you want to call it overspending, or maybe spending appropriately if we needed to have the economic thrust come in from government stimulus to the economy. But we were already running those large deficits, as I said, in 2018 and 2019. So I start this graph midway in 2018, and we see that the government debt, the total federal government debt, rose from about 21.25 billion. It rose to 22.25 billion a year later. In other words, it was rising about $1 trillion a year. And as I said, we had $1 trillion deficit, which means you got to borrow $1 trillion. And if you borrow, it means you're $1 trillion more in debt. So it's all making sense. Now, if we were running deficits, you may wonder, why is the debt flattening out? That was just the government playing games. They wanted to pretend that they weren't overspending, that the debt wasn't rising. So as you know, once in a while they pass these debt limits when they're saying we're putting a cap on the debt. It's not going to get bigger. But if you're still running a deficit, you still got to borrow. So they play some accounting tricks until there's no more leeway with the accounting, and then they have to admit that they have to raise the debt ceiling. And so that's what they did after a while. And that's why you see a vertical line, a jump in the debt, once they could unwind some of those accounting tricks and actually borrow more conventionally. Then the debt is still going up rapidly. We're having a big government deficit, historically very big, as I showed you. And then, of course, here comes the pandemic. And we had to lock down, and we lost again 22 million jobs. Always remember that. 1 out of every 7 workers suddenly not paying income tax, Social Security tax, Medicare tax, and others with their income way down. Either the firm said, we'll keep you on the payroll, but with fewer hours, or you got to cut your wage. So all of a sudden, there's a lot less tax coming in, and the government spends, again, I think appropriately, but that's, you have the freedom to think differently. The government spends a lot to get money into people's hands before they get foreclosed on, or their kids get hungry, as I said. So the debt jumps. We had that deficit of over 3 trillion, and it continues. The debt has actually jumped $3.75 trillion. Now, what this means is the future is now very uncertain in terms of the government debt. Is this sustainable? I don't think it's going to hurt us for many years, but could it hurt your kids to have so much government debt? Will they have to be taxed more later to make this debt sustainable, to make sure it doesn't explode? Will they take haircuts on their Social Security, get maybe 20% less Social Security benefit? There's no way they're not going to get any Social Security. There probably will be means testing on the amount you get. Maybe if someone was wealthy, again, this is at least 15 years old, maybe 20, but if someone's wealthy, maybe their Social Security payment will be less. Maybe they'll be paying Social Security tax, not just on their first certain amount of money and then it's capped, but just like with Medicare, paying the Social Security tax rate on all their income, because there will be some actions taken in the future because of this explosion of our government debt. For perspective, by the way, the total federal government debt was 1 trillion in 1980, and it just hit 27.25 trillion. Now, be aware the economy is bigger now than it was in 1980, but still, it's not 27 times bigger. Now, I don't want to get you nervous. That's not my point. Again, things are sustainable. Social Security is going to be paid in Medicare. We are saved by extremely low interest rates, record low interest rates, particularly on government borrowing. As you know, the Federal Reserve has acted very aggressively to lower interest rate on shorter term items, things that are called treasury bills, like when the Treasury borrows for 90 days, close to zero. And we're going to see even on longer term things, like even if the Treasury borrows for 10 years on a 10-year Treasury bond or 30 years, interest rates are extremely historically low. So when you have 27 trillion of debt, you're really lucky and really glad when the interest rate on them are so low. But if interest rates ever went up, and they won't in the next couple of years, but if they ever went up, let's say 3%, what is 3% more paid on interest on 27 trillion of debt? That's over $800 billion. Imagine if we already have a deficit. We're paying for military, we're paying for retirements. We need to pay for both of those. We need to. And then we throw on 800 billion more of interest every year. That would lock us into very large government deficits, partly because of all the interest they're paying. That means they got to borrow. That means more debt. That could mean more interest. Don't worry. I do believe interest rates will stay low for quite a while. But if they go up, you can see how that's a vicious spiral. More deficits, that means more debt, more borrowing. But higher interest rates on more debt means we're going to have future deficits because our interest bill is so much, right? Swallowed by how many interest payments. So that's down the road. But again, for generations younger than myself, I'm in my 60s, it would be a worry. So we'll move to the next slide. And on the next slide, we are going to talk about who actually holds this $27 trillion of debt. So the top line is the total federal government debt. You know, it's federal, but states and local usually don't hold much debt. They often have unfunded pension liabilities for some of their workers, particularly Illinois and California, are in a mess, as you know. But many states by law aren't allowed to run deficits, which is why it's a tough situation now. They've got to cut back a lot of their spending since tax revenues come down in a pandemic. All right, now, so the gross debt is 27 trillion. That's purple. But an interesting thing is the orange, which is about 21 trillion, which is the debt held by the public. By the public, we mean anybody but an agency of the federal government, by its own agencies. In other words, it can be held by private individuals. It could be held by yourselves. It could be held by foreigners and foreign central banks, They still trust the US. We're still in many ways a safe haven when things get bad. So they hold a lot of our government debt, our treasury securities. And if you're, say, in Switzerland and you want to diversify your wealth, you know, that idea of don't put all your eggs in one basket, you want to hold some US government debt, especially against a rainy day, because we are seen as a safe haven. We do have the rule of law, we have intellectual property protection, the world's finest military, et cetera. Not that we don't have problems, but we also have those great assets that make people want to hold some of their wealth in the US. Okay, so actually the green shows debt held by foreigners. Now, when I say foreigners, I mean non-US citizens. I don't really like to call people foreigners. You know, as many as 40% of my students in goes way to business school are sometimes non-US students, international students. And not only do they contribute their perspective and their brilliance, but you know, when students pay tuition to Emory, it helps Emory, but it also helps the United States, because that means at Emory, we are bringing money into the US. Well, that's what an export is. If you sell a car to Japan, well, that's an export of a car, and they pay for it and money comes into the US. It's the same thing if a non-US person pays tuition to Emory. That brings money into the US, which helps the US trade balance. I feel like Emory is a great contributor that way, just as the students contribute within our classroom. And those who stay here contribute within our labor force. But another way that non-US people contribute in non-US central banks, et cetera, is we have this government running this huge debt. Who's buying it? And if no one buys it, the price of the bonds will go down if there's no demand for them. And those of you who hold fixed income in your retirement accounts, and that's most of you, and you shouldn't have it all in the stock market. Well, if the price of bonds come down, you would lose money in some of your fixed income holdings. And by the way, interest rates would go up too if we didn't have money flowing in from abroad, holding our debt. And as you can see, that's $7 trillion looking at the green. But what separates the orange from the purple? I kept talking about held by agencies of the government, et cetera. Okay, well, the total amount of debt that the Treasury has issued because we run government deficits is 27.25 trillion. We saw that. But we only have to sell 6 trillion less of that to individuals or to international entities, et cetera. If you look at the black, 6 trillion of the Treasury debt is held by agencies and trusts of the federal government. Now, that is mostly the Social Security Trust Fund, to a certain extent, the Medicare Trust Fund. You may all remember when Al Gore said, I'm gonna build up a Social Security Trust Fund, so when the baby boom retires, that's going to be a lot of benefits we have to pay out when the entire baby boom is retired. But we'll have a trust fund of trillions of dollars that can then be tapped to pay for benefits. And it's a good thing we did that, because we're going to have many more benefits paid out. And of course, in terms of Social Security or Medicare tax going in, we'll still have a lot of workers, but not nearly the growth, as I said before, the growth of the workers paying in, as we will have retirees deserving and getting benefits. So we've built up this trust fund. I go back on this graph to 1992 to show you that these 28 years were years when the baby boom was working and paying in most of the time, although the last few years, baby boomers have progressively been retiring. And there's been a great growth in these trust funds. And that should give you some confidence that there is money there to pay out benefits. On the other hand, you can see that that black line has flattened. And the reason it's flattened, of course, is that there are more benefits going out now as more and more baby boomers retire. But again, it's flat. It's not coming down because there's still plenty of people in the US paying in and working. If you have really good eyes, you can see the black was just starting to turn down. part of that is as more and more baby boomers retire, there will be more payment out and the black line will come down. We will exhaust the trust funds. But if I had the latest data, sadly, it's probably going to be another month before we get the next quarter of data. I can make that available to you through Samantha Renfro. But we're going to see the black line come down a little more because in this pandemic, a lot of people haven't been working, as I've talked about. And when you're unemployed, you don't pay in your Social Security and Medicare tax. So you're not adding into the trust fund, even as benefits are coming out. But I wanted to show you this because look at this. This was 1 trillion in 1992. Now it's got 6 trillion. There is a lot of money in these trust funds. Again, it doesn't mean they won't be exhausted, but the Social Security Trust Fund will make it at least to the 2030s, for example. And at that point, again, maybe people that are working then will be taxed somewhat more. It doesn't take, by the way, I hope people don't get the idea. It's not like we can't pay benefits. Current studies show, well, if people are taxed maybe 15% more for Social Security, again, maybe if we don't cap what they're taxed on, so wealthy people keep paying certain percentage for their whole income, the system is fine. It doesn't go from like paying full benefits to nothing. All right, now we'll move to the next graph.
Jeff?
Oh, please, Andrea.
Yeah, I hate to interrupt because
Anytime.
it's just so fantastic and I'm mesmerized. We had a couple questions on this
Good.
slide, and I think you may have hit a nerve on the government debt owned by foreigners and the percentage. You know, why didn't we lock in percentages, and is it still attractive debt? Can you comment on that?
I'm not sure I quite understand.
It was
locking in foreigners, making them hold the debt, or
2 different questions, and I conflated them. So let me undo.
You certainly did. I won't take back your MBA though.
Hey, it's right there up on the wall.
Yeah.
Did we not lock in interest on this debt, or does the interest?
Oh yeah, no, that's a good point. Like debt they bought in the past, let's say it had a 4% interest rate, a bond, that bond will continue to pay 4% interest. You're absolutely right.
So it goes up and goes, so
yeah.
it's not gonna.
Fortunately, a lot of what non-US people and central banks hold are fairly short-term, 90-day treasury bills, 1-year treasury bills. So even if they had bought them when there were higher interest rates, now they mature. And if anyone wants to reinvest in what's called roll the money over, now they can only get the current interest rate. So that was a very good question. By the way, even if I don't cover all my slides, I want to uncover a worry I have, which is, what do retirees do? Some of you may be retired, and I have great empathy. I wish I had more answers, because some of you own bonds that maybe had a 5% interest rate or 4%, or many very intelligent retirees did what's called laddering. You had some 3-year bonds, some 5-year, some 7-year. But as they come due, maybe they were paying 5% interest, and now you go out there and you can only buy a bond for 1% interest. Or your money in a retirement account, the fixed income, they're paying out less interest in it. Or if you had $200,000 in a money market account at a bank, now you notice the interest rate is like 0.1. And even if you're aggressive and find an internet bank that make sure it's FDIC insured, and many of them are, but they pay 0.5%. Now, this is totally unfair to retirees because inflation is close to 2% for the US, and no doubt more than 2% for retirees when you consider the cost of healthcare, et cetera. So when we think, let's say we even get a 1% interest rate. So we put in $100,000, and at the end of the year, we get 101,000, let's say, in the bank, and we don't even get 1%. Well, do we have more money? We don't have more purchasing power. We have 1% more money, but if prices went up 2%, which they will, especially for retirees, we actually fell behind in terms of purchasing power. So I have a great deal of empathy right now for retired people because I understand why the Federal Reserve drove interest rates down near zero, because we were in or risking an economic depression. And they felt if interest rates are near zero, economic theory says if interest rates are high, people, in let's say people that are working or retired, but will save their money, put it in the bank to earn this high interest rate. If interest rates are like zero, people are going to be, what's the sake of saving? I'll go out and buy a new car, new mattresses, and particularly mortgage rates being very low. Maybe I'll go buy a house. So as a way to stimulate an economy that was literally dying, they drove interest rates down to zero. Also, for a firm might say, we were thinking about buying that new equipment or investing in some research, but if we got to pay, say, a 10% interest rates to borrow to expand our factory, we can't afford it. But if we can borrow at 1 or 2%, well, then we can afford. That's not having to pay very much interest. So that's economic theory, that if you need to stimulate an economy that was literally dying, you drive interest rates to zero. But other than myself in some of my speeches, I never hear anyone talk about how hard this is for retirees. That right now we have a negative interest rate on bonds, on bank accounts. It may not sound negative, but it's negative, what we call a real interest rate, when you subtract off the inflation and you look at the impact on purchasing power. Now, maybe that's one reason the stock market has gone up so much, and technology stocks, and even gold for a while, because people were saying, well, what do I do with my money? I can't sit around and earn zero. But of course, that gets risky itself. So I guess the best advice is what sounds so silly. It's like, we pay guys like Jeff to be finance professors at Emory, and the best they can advise us is don't put all your eggs in one basket. But that's about what we have to be doing right now, is keeping very well diversified, not to be overly afraid of various asset classes, but not put all our money, for instance, in technology stocks. That would have been nice, by the way, 6 months ago, but maybe a little bit, hoping for some growth, maybe various things. Real estate has always seemed to be, maybe in the longer run, a safe place, but nothing is quite safe in the crazy world we live in. All right, but that was excellent, Andrea.
There was a follow-up question from Joyce Klimmer. Joyce, do you want to ask a question?
Excellent. Yes, unmute, Joyce.
Well, basically, all I was asking was, you said there's approximately 6 to 7 trillion being held by foreign investors or overseas investors. Are they still going to want to hold US debt when interest rates are so incredibly low?
I think that's a brilliant question, Joyce, because I've always thought that they probably will, but we're extremely vulnerable. For instance, well over $1 trillion is held by the Chinese central bank, which is a branch of the government. If they ever wanted to, they could dump $1 trillion of our treasury securities into an open market. And it's just like farmers. If there's a lot of wheat, if there's an excess supply of wheat, if they go to the market with too much wheat, the price of wheat's going to come down a lot. Well, if they ever came to the market with a lot of treasury bonds and dumped them into the market, suddenly there'd be an excess supply of treasury bonds and their price would come down, which hurts all of us, and life insurance company and pension funds, and maybe Emory's endowment that holds treasury bonds. So we're very vulnerable. And in some sense, Japan, China, countries like that own a lot of treasuries do have some leverage over us. Now, later I'll get to a graph, or if not, I'll ask Samantha to send them to people, that shows interest rates. And as low as our interest rates are, Joyce, you probably heard that in some countries, they actually have negative interest rates. So some of them have been putting their money in the dollar because at least it's not negative. You do wonder,
how does that work? What is a negative interest rate? I mean, what they make you pay at the end of the year?
Yeah, basically, imagine if you put $100,000 in the bank, and at the end of the year, you have 99,500 because they usually have not big negative, but like negative 0.5%. I always wonder, why don't they just stick their money under the mattress? But there was some book, was it Silas Marner or somebody did that and then it got robbed? Maybe for the security of having their money somewhere, or maybe because they can write checks against it. But the idea again is their economies haven't been doing well in a place like Japan. So it's to try to get people to go out and spend. It's like flush their money out of the bank account where they actually see their account going down instead of going up. But again, well, that's great if you're trying to get 30-year-olds to spend. I don't know what that does to a 70-year-old who's retired when they see their account go down. All right, this is really an excellent discussion. We'll move to the next graph and then we'll continue discussion. So as I pull up the next graph, I want to tell you that what actually happened and what helped drive interest rates down towards zero, and which did make the price of bonds, if you did own bonds in your portfolio, what did make their price go up is, and here I start in all the way back in 2008. See, the Federal Reserve traditionally has, our central bank has traditionally held treasury securities. If it wants to expand the economy, it buys bonds. And how does it pay? It pretty much puts money into the banking system. It's a little more complicated than they buy bonds and print money to pay for it, but it's the basic idea. So they get all this money into the banking system, and then the banks can expand credit. They can give more loans, but also increases the supply of credit. And like I said, when you bring more wheat to the market, the price goes down. If you bring a lot of credit out to the market, people don't have to pay as much interest if there's all these banks wanting to loan. So in 2008, I started at the beginning of 2008 because, as you know, then things started to crash. The Federal Reserve started buying bonds to support those markets, the bond markets, and to put money out into the banking system. You see, take the blue, mortgage securities. So banks give mortgages, and therefore they hold mortgages, and then they bundle them up into securities. If you saw a great movie like The Big Short or Too Big to Fail, that's what was going on. These banks were bundling up these mortgages, unfortunately, often selling them to unsuspecting individuals. And then we found out those mortgages were pretty worthless if the banks gave loans in this housing bubble that were not loans they should have been giving to people who really couldn't afford them. So anyway, the mortgage securities, these mortgage bonds, were starting to collapse in price when we realized that this housing bubble was crashing. So the Federal Reserve stepped in that era and bought $1 trillion of mortgage bonds just to support the mortgage market and the mortgage bond market. And, you know, we did eventually get things going again in the economy, and the housing market eventually came back. And then the Federal Reserve, in various steps, we called them QE1, QE2, QE meaning quantitative expansion. We expanded the money supply. So that's the red, as well as the blue. The green adds it all up. The Federal Reserve is buying assets, buying bonds, for instance, mortgage bonds, treasury bonds, and paying for them by putting money out into the system and putting credit out there to try to stimulate the economy. QE means quantitative expansion of the money supply. Buy bonds, increase the amount of money so that it can stimulate the economy. More money available, more credit available. Well, we thought those were big steps, except look what happened starting in March, April of 2020. You see the green jump? That's the total amount of assets the Federal Reserve, like bonds. What happened is we bought some mortgage bonds because the mortgage market was under some pressure in April. So we bought some mortgage bonds. But what they really did is they financed the over $2 trillion CARES Act. The Treasury, instead of having to go to the open market, people like you and me, and try to sell us Treasury bonds when we were all nervous or losing our jobs, so we couldn't buy Treasury bonds, we couldn't buy anything. The Federal Reserve stepped in and said, we will buy all those bonds that the Treasury is issuing. The Treasury is, on behalf of the federal government, is issuing a tremendous amount of new debt to borrow, because we had, as I showed you before, an increase in our government debt of $3 trillion when we had this $3 trillion government deficit, as we have spent so much. Again, I'm not criticizing anybody. I'd rather spend a lot and get in debt now and worry about the debt someday than have seen our economy be like a 1930s Great Depression. But you can see the upshot is the Federal Reserve bought a tremendous amount of Treasury securities. It literally went from 2 trillion, as you can see, to 4.5 trillion. Will this one day be inflationary? It could be. Milton Friedman once said, or defined inflation as too much money chasing too few goods. Well, there's certainly a lot of money out there. Now we don't see the inflation because, for instance, people aren't going to demand higher wages. We're still in a very, worrisome economy with high unemployment, but one day we may see inflation, which again worries me. If you're invested in, for instance, a 30-year bond, that if you buy one now at an interest rate of a little over 1%, if we do have inflation one day, it means you're going to fall behind in terms of purchasing power. Very unfair to retirees. All right, we probably have questions, but let's get one more graph up there because it's so crucial. So we're going to look at my final graph. We timed this well. This is exactly what I'm talking about, so I wanted to end there. Go back to the beginning of this century, January of 2001, I start this graph. Whether it's a short-term 90-day Treasury bill or in green, or the 10-year Treasury bond in red, or the 30-year bond, which is in blue. For a while, they didn't sell 30-year Treasury bonds. They didn't want to borrow and owe people money for 30 years. That's why the series breaks and starts again. But rates were around 5.5%. Again, as an individual, as an insurance company, trying to invest the premium so they'll be ready when people do pass away. As retirees trying to earn some income, you got 5.5%. It went down a little bit because we had a recession. Then it got up to 5%. It's been a long-term trend down. As you know, it was very high in the 80s. But look what happened just since March. At least we were still getting on the different instruments 2% or 3%, and 3% on bonds, which is the red or the blue, exceeded the inflation rate, which was a little below 2%. So you could stay ahead of inflation. You would gain purchasing power on your savings. But now the 90-day Treasury, the short-term one, the Federal Reserve, by printing so much money and buying up all these 90-day Treasuries, has driven the interest rate almost to zero. And even if someone buys a 10-year bond, they were only getting less than 1%, about 0.75%, except luckily in the last week or two, people have become a little more optimistic with the election behind us, with vaccine trials going pretty well. So people feel a little better about the economy. So they think, well, maybe the Federal Reserve won't have to keep acting to keep interest rates so low forever. So interest rates have gone up a little bit. And if you buy a 30-year bond, for instance, the blue, all of a sudden you can get 1.5% interest rate. The only thing is 30-year bonds are very risky. You see, if you buy it, you're basically locking in. Someone mentioned locking in before. Andrea talked about it, and she's right. If you buy it and if you hold it for 30 years, you're locking into only getting 1.5%. Now, that might be bad if interest rates go up in the future and you're stuck locked in at 1.5%. So my conclusion is the Federal Reserve did what it had to, which is get interest rates down to try to stimulate the economy. And by the way, why did the stock market go up so much? We still have high unemployment. We still got great fear. We don't know what's going to happen. Like I said, we might even have a W, another fall into recession. The stock market went up so much because a lot of people said, what else am I going to do with my wealth? If I'm earning 0% or 0.7 of 1%, not 3%, that ain't going to do it for me. That's not the amount of income I need. So they plunged into the stock market. Well, that was nice. Again, that doesn't mean from this moment forth, it can only go up. No one knows about stock markets. I'll conclude there. If it was obvious they should be higher, it would be higher now. Smart people would jump in and buy it. If it was obvious it was going to go down, it would be lower now. People wouldn't sit around holding stocks when it was obvious it was going to be lower. So no one really knows. And that's, again, why you need to diversify and hold many different asset classes as you can. But ultimately, it's very hard if you were hoping to get a nice income off of your savings with these kind of interest rates. All right, just about out of time, but Andrea, is there one great question out there? We'll pull down the slide so we can see everybody. And if there isn't, I will bid people adieu. Are you muted?
Yes, I was, because I didn't want you to hear my cat. Joyce had another great question. With interest rates so low, how can credit card companies charge 18%? I love that question.
Well, I can say one thing is they would say because a lot of people don't pay off their credit card, so they're taking risk and they need that what's called a margin, earning 18, only paying 17% to make up for people that never pay. There's a little bit of that, but that's mostly an excuse. You can see why credit card companies do so many advertisements, because they make a lot of profit and put it into advertisements. I'm going to say something that may sound controversial, but we do have a Consumer Financial Protection Bureau, and I think we need to put more muscle into that. I do think certain consumers get don't get proper representation. I say that as a business school professor and a capitalist, by the way, and I think people need credit, and companies do a good job of providing credit. But when we get beyond very, established companies, when we're thinking about things like people that are poor and need payday loans, sometimes these payday loans, they pay over 100% at an annualized rate, over 100% interest. Again, this is very personal and it's not political. I would like to see more protections for people that are poor, that are, for instance, what we call the non-bank. They don't even have enough money to really have a lot of money in the bank, so they are vulnerable. So I did want to end with that point. But the other thing I want to end with is, I'm so glad those of you who are on this call or who will see this on Emory's YouTube channel, because we all have to be lifelong learners, and the world is changing so fast. So stay tuned. I'll continue to update some slides and send them through Samantha if that's useful for you.
Yes.
I do want to say something about being a finance professor and a global economics professor. I have to change my syllabus, even in the middle of semesters. The world is changing that fast. So we all have to be lifelong learners, me more than anyone. But I'm glad you're associated with Emory, because I promise we'll continue to bring you the latest and the best thoughts we can generate. Well, thank you for joining us today.
Thank you, Jeff. And I love your point about lifelong learning. Thanks to selfless people like you and Jag and Rick educating us and arming us with all of this information so we can continue to learn, which I think is so very important, especially in these times where we don't have the same social stimulus. I took 5 pages of notes. I don't know about everybody else. We'll see if they make sense when I try to relay them to my husband. But you know, something I didn't mention, you broke down difficult concepts in a way that even I could understand. And I really appreciate that. This was just absolutely fascinating and so educational. We really appreciate the time and unbelievable information you shared with us.
And
Thank you, Jeff. It was fabulous. So I'm so appreciative of your time, and I know how busy you are. So thank you. And I'm seeing some great comments about how great they thought your presentation was. So fantastic.
Lots of
Take care. And
well, Emory has great professors, so bring in others, but be willing to come back in a year. And again, Samantha, I don't know what our business school would have been without you and Al
Oh.
Hargraves, Julie Barefoot and Andrea Hershatter. We had a few heroes that have held this school together and made us the prominent school we are these days. Emory's known for everything we do in the medical world, and we're tremendous, but it's people like you, Samantha, and our Hargraves and other that have held our business school to the high standard that we've now achieved. So
Thank
take
you.
care, everyone. If
You
you have any
too.
great ideas how to invest in this crazy environment, tell me. So take care.
Happy
Thanks, Jeff.
Thanksgiving. Okay,
Take care,
bye-bye.
Take
Thank
care,
you, Jeff.
Steve. Take care, Sean, Nancy, and others. Bye now.
Be safe, everyone.
Bye, everybody.